Hello everyone. In this presentation, I am going to discuss calendar spread. Calendar spread is an options trading strategy. It is different from other options trading strategy because in calendar spread, we have different expiration dates. Unlike other option trading strategies where we have same expiration date, calendar spread has different expiration dates. So let's find out what is calendar spread, what are the types of calendar spread, and what are the payoffs from the calendar spread. So till now we have discussed the bull spread, bear spread, box spread, butterfly spread, straddle, strangle, strips and straps. So we have covered all these option trading strategies. We find that some option trading strategies are normal spread like bull, bear, box and butterfly, which are created either by using a call option or by using a put option. But some option trading strategies are combination spreads like straddle, strangle, strips and straps. Another important point is some of the option trading strategies use only one strike like strips and strap. Some trading strategies use two strikes like bull, bear, box. But strategies like butterfly spread use three strikes. So all the option trading strategies have their unique feature. But one point is common in all these spreads. That is, all the options used to create these spreads have same expiration date. All expire at same time. So up till now, we have assumed that options used to create spread all expire at same time. So now in this presentation, we will see calendar spread in detail and try to find out what makes calendar spread different from other spreads. So the question comes, how calendar spread is different from other spreads? So the answer is calendar spread is an option trading strategy which has same strike price K but different expiration dates. Here we have taken T1 and T2 which shows it has two expiration dates. Because of different expiration dates, this spread is called calendar spread, which is the unique feature of this spread. Another important feature of calendar spread is that it is a normal spread. It is not at all a combination spread as it can be created either by using call options or by using put options, but not both for creating the same strategy. Another point which I would like to mention here before moving to the strategy of calendar spread is that since we have different time of expiration, that is T1 shorter time and T2 longer time of expiration. So here I have taken calls, short call and long call. So when you are taking a short time, your curve will be a king-shaped curve as you have created a strategy in earlier spreads. So here is a short call where your curve become king at the strike. But when you deal with a long term maturity at a longer time, your curve will be a smooth curve. Since it is a call, we are expecting the price to go up. So a smooth curve, the price is going up without any king at a strike. Likewise, if you are creating a calendar spread using put options, taking short put and long put, for short put, for smaller time maturity T1, the curve will be the same king shape. It will be king at the strike of K. But if you are taking a long put at higher maturity T2, this curve will be a smooth downward sloping curve. There will be no king shape in the curve which is drawn for a longer time maturity. Now let us see the calendar spread which is created using call options. So for creating a calendar spread by using call options, we need to make a strategy by taking a long position in call option, that is long call, or buying a call that matures at one time T2, that is combined with taking a short position in call option, that is short call with maturity at a different time T1. We take long call with a longer maturity. So buying European call option with a strike of K with longer maturity T2 combines with selling European call option with a same strike of K with shorter maturity T1. So one thing is clear, we have to buy call and sell call. Both buying and selling call are exercised at same strike K. Another important point which we have to remember is the longer the maturity of an option, the more expensive it is. That means long maturity options are more expensive. Therefore, to create a calendar spread, it usually requires an large initial investment. So the profit diagram from calendar spread shows the profit when the short maturity option expires on the assumption that the long maturity option is closed out at that time. Let us see the profit pattern for a calendar spread produced from call options. With the help of the figure, the profit from calendar spread calculated using two call options, short call with a lower maturity of T1 and long call with a higher maturity of T2 for a same underlying asset with the same strike price and two different expiration date T1 and T2. So first we have to keep in mind is that the profit is calculated at the time when the short maturity call option expires. So let us draw the figure. This is the profit and loss line, the stock price line. We take a single strike. Now let's create a strategy. This is short call at the lower time of T1 and long call with a high maturity of T2. So as soon as we short a call or sell a call, the amount is credited to our account. Now short call will be in a king shape at strike of K. So this shows that if the stock price goes up, short call will have loss or it expires, but if the stock price goes down, short call will have a limited profit. Now we see the long call with a higher maturity. So this long call with a higher maturity has a different shape. It is a curve, smooth curve moving upward. It is no more a king-shaped curve when we draw a calendar spread for a longer maturity. So as soon as we buy a call, long call, the amount is debited from our account. Now drawing a total payoff, we see that the strategy shows that the investor makes a profit if the stock price at the time of expiration is close to the strike price of the short maturity option. So as soon as it is close to the strike price, the strategy will give us profit. But when the stock price is significantly above or below this strike price, investors have losses. Let us find out the profit pattern from the calendar spread using call option. So we have discussed the figure already. This is the calendar spread using call option, short call and long call. Now we will discuss the payoff table of the calendar spread using call option. So to understand the profit pattern from the calendar spread when the short maturity option expires, let's take two probable situations of the stock price at the time of expiration. So first situation is if the stock price is very low when the short maturity option expires. So in this situation, the short maturity option is worthless and the value of long maturity option is close to zero. So therefore, investor incur loss that is close to the cost of setting up of spread initially. Now let's take situation 2. If the stock price is very high when the short maturity option expires. So in this situation, situation number 2, the short maturity option cost the investor which is equal to ST minus K, whereas the long maturity option is worth equal to ST minus K. Whatever stock price is higher than the strike is the profit for a long call that is of long maturity. But again, when we add it up, we get the total payoff 0. So again, the investor make a net loss that is close to the cost of setting up of the spread. So this clearly shows that if the stock price at the time of expiration is close to the strike price of the short maturity option, the investor makes a profit. But when the stock price is significantly below or above the strike price, the investor have losses. So initially, if the stock price is close to K, the short maturity option costs the investor either a small amount or nothing at all. However, the long maturity option is still quite valuable. So in this case, a significant net profit is made. So this is the profit which is showing that the stock price at the time of expiration is close to the strike and investors are making profit when the short maturity option expires. So this shows that strike price plays a very important role in deciding the profit in the calendar spread. So next question comes here is that what should be the choice for the strike price in creating a calendar spread? So the answer is the choice for the strike price in creating a calendar spread depends upon what type of calendar you are trying to create. A natural calendar spread or a bearish calendar spread or a bullish calendar spread. So for this you have to see the option chain. So if you are trying to create a natural calendar spread, that means you have to choose the strike which is very close to the current stock price of the underlying asset. So here the underlying is Nifty. We see the current stock price. We take a strike price which is very close to the current stock price. So we will choose this strike and we will create a strategy. But if you want to create a strategy for a bearish calendar spread, you have to choose the lower strike price. If you want to create a bullish calendar spread, you have to choose a higher strike price. So far, we have seen the calendar spread created by using call option. Now let us see the calendar spread created with put options. Let us see the calendar spread created by using put option. So for this, we create a strategy that is buying a long maturity put option, long put, along with selling a short maturity put option, short put, with the same underlying asset, same strike price of K for both long put and short put, but at a different expiration date. That is, long put at T2 having a longer maturity and short put at T1 with a shorter maturity. So let us see the figure which shows the profit from the calendar spread using put option. The important point which we have to keep in mind is that the profit is calculated at the time when the short maturity put option expires. That is short put which expires at T1 time. So this is a profit and loss line. This is a stock price line. This is the strike, that is K. Now first we make a strategy with the help of short put. So as soon as we short a put or sell a put, this much amount is credited to our account. Now if the price goes up, short would have a limited profit equal to the option price. If the price goes down, short put expires. Now another strategy which we have to take here is buying a long maturity put option. That means long put. So long put means buying a right to sell the underlying. So if you buy a right to sell, you have to pay the option premium. This much amount is debited from your account. So when you create a total strategy, it will be shown with this white dotted line, which shows the total payoff. So the profit pattern from calendar spread obtained from put option is similar to the profit pattern of calendar spread obtained from call option. So important point here is to remember is a small profit arises if the stock price at expiration of short-term maturity option is well above or well below the strike price of the short maturity option. However, a loss results if the stock price is very close to the strike price. If you have any question on this presentation, please put your question in the comment section and like and subscribe my channel to get further notification. Thank you so much.